Hey Robinhood traders, this is Ron Hay from MarketTamer.com. I'm going to be sitting in for Mark this weekend. He'll be back with you next week. So for the next 10 minutes or so, I'm going to be your guide through the markets. But before I go any further, as always, everything in these presentations are for educational purposes only and is not advice or recommendation to buy or sell anything. Alright, what a week in the markets. Holy moly is right. Mark, I know, has been briefing you guys talking about this rally from the February 5th low and how it's been on such light volume. And something Mark and I both have been talking about inside our classes at Market Tamer is when this rolls over, it could be sudden, it could be dramatic, and you might see a month or two worth of gains literally evaporated in just days. Well, that turned out to be a bit prophetic, and we just fell right off a cliff here. Now, there was no way to know we were going to have the disaster day on Thursday, which was literally unprecedented in terms of point loss. But, could you have seen it coming? And the answer is, well, in a way, yes. On this chart here in blue is the 5-day EMA, and in red is the 20-day EMA. And we have been using these EMAs as really nice trend lines. And we began talking about the big down day that started on 416, and then more importantly on 427 was a big one. That was a big down day. 2 days later we rally a little bit, and then boom, we come down again, sort of like warning shots. And what we started drawing here on the index is we drew this basically symmetrical triangle, and we started just pounding up and down, and the range was getting narrower and narrower and narrower. And we talked about the fact that if we break out of this triangle, and not just the break itself, but if I zoom in a little closer, you can see all these lows, literally going back from 416, 419, 427, 428, 430. If we violate all these lows, which can sort of be drawn horizontally here as support, that's not only going to result of a break out of the symmetrical triangle, but also a break back below the 5 and 20-day EMAs. That all happened on 5-4. That was the trigger. I often like to use the 5 and the 20s as whether to stay in or out of the market in terms of the majority of bullish or bearish trades. Since we're above the 5 and 20, the majority of trades can be bullish. When we close below the 5-day, that tells you, all right, time to think about taking some off the table in terms of bullish trades. When we close below the 20, that is another major indication. We had a little chopping around in here, so you might have decided to get out, maybe get back in a little bit, but we highlighted this triangle. So important. And when we take out these lows, that's going to be the kicker. That will be the last line in the sand to say, if you still think you're bullish, time to get out. Well, we closed below there, and at the end of the day, when it looked like we were going to close below the 5 and the 20, that was the trigger. Even on Wednesday when we had that doji, same thing. You could have gotten out in the morning per se, and that would have avoided Thursday and Friday's decline. Hindsight's 2020, but for those folks that have been with us at MarketTamer.com, they were pointed out to this pattern, and it was a very dangerous pattern. Something bigger has actually occurred now going forward. The 5 and 20-day EMAs have crossed. The last time they crossed was back here during the January and February correction. Once they crossed, we had more down pressure, which we've seen the last couple days, consolidate, go down, try to rally, and then roll right back over until we printed that hammer, very important hammer on February 5th. Well, because of the news in Greece, that's what some of this is attributed to. There's been major problems in Europe, which we've been highlighting in our chat with the pros sessions. But Thursday, they're blaming on a mechanical glitch. It's sort of like, give me a break. There's fail-safes in our own accounts. Are you telling me there's not going to be a billion-dollar fail-safe not in a big account? There's also some commentary out of the ES futures, the E-mini pits, and also out of the Japanese yen that there may have been, because everything's so tied together that one little snowball turned into a giant avalanche. So they're still trying to figure this out. And will we really ever know what happened? Probably not. They're not really going to tell us. They'll scare everybody. But nonetheless, we've had this big move. Now, looking forward and trying to plan for the week ahead, everything that happened in the past is fine and dandy. But where does that leave us right now? Okay, this big bar on Thursday, in a way, is unprecedented. We saw the biggest decline in the history of the stock market in terms of Dow points. The S&P was down over 100, NASDAQ was down over 200. This incredible range totally destroys the technical picture that we would normally look at as traders. Clear-cut resistance obviously way up here, right? 426. These highs is the massive new resistance level. That's a whopper. And massive support is going to be the February 5th low, that candle back here. Well, look where we are. We're sort of in the middle to lower end. In essence, that is the broad range of the markets right now. But in the very near term, what we can do is actually go back to Thursday's candle, the high and the low. We're probably going to vacillate in here a little bit. It's a good thing the weekend came around. It can let things settle down a bit. People can catch their breath. So this big candle is going to be short-term support and resistance. But further, keep an eye on the 5-day EMA. If we break above the 5-day EMA in blue, which right now in the SPX, which is the SP 500, is 1146, if we can close above there on strong volume, that will be a good sign. However, if we close below Friday's low, that will be a bearish sign with immediate support coming in at the bottom of Thursday's candle and then the low of February 5th. Now, one interesting thing as well is this moving average right here, sort of like an off purple color, is the 200 SMA, or 200 simple moving average. We tagged that on the S&P on Friday. That's a natural bounce point, so it's not surprising that we did bounce off there. So expect more consolidation, but the real break comes on a violation of, well, let's start with Friday's low, next target immediately Thursday's low. It's the only thing you really have to go by, and then the February 5th low. To the upside one more time, a close above the 5-day. If we can get above the 5-day, we go right to the 20-day. And right now, that's sort of where this previous support level was. We get above the 20, we can then start focusing on these highs all the way up here, back on February 26th. So in between there, gang, there's just a lot of range, a lot of movement. We know some folks that were following us with the 5 and 20-day that took that caution, and they were well protected, well hedged. You know, one of the ways I like to hedge in the market for this type of thing is to have gold and silver in a portfolio. When the market was getting hammered, gold and silver were rocketing higher, especially gold specifically. Silver caught up on Friday really well, but gold went nuts. That's a great way, in my opinion, to help protect a portfolio. So, other ways to protect, we had some emails. You can buy inverse ETFs like SH, Sam Harry, DOG, Delta Oscar George, which is the single short Dow. There's double inverse ETFs like the UWM, Unicorn Whiskey Mike, or Sierra Delta Sierra, SDS for the S&P. There's some other inverse ETFs you can purchase, but you always got to do your homework on them because the double inverse, are rebalanced. So just check that out. Make sure you're comfortable with it. But I don't think in terms of the downside pressure, is it truly over? I think we could see ourselves drifting down a little bit, but often these sharp corrections often occur in bull markets, not necessarily bear markets. Bear markets usually end in rounded tops. A lot of slow death occurs up and down, whereas the bulls get quick corrections, wash out the weak buyers because it's been such an easy rally, and then you resume the uptrend. We have to get back above this high to give S&P 1300 a real chance. If we break this February 5th low, which is absolutely critical, a violation of a major swing low like occurred here in February, that would mean the bears are back in control. So right now, we're in the middle of the range. We got a huge range to digest here. Watch these points. Oh, one more thing. If we come back up and test the 5-day EMA and we get rejected and we start to roll over, that could be another great opportunity to get short because it probably means we're going to come back down and test these lows. So with that, gang, it should be a very interesting week. Mondays have been bullish. Let's see if it holds true. We just need more data to get a better picture on what's occurring right now because of this huge candle and all this emotion. With that, wish you all the best. Take care.